Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight are Andrew Padoa from Sasfin Wealth and Gary Booysen from Rand Swiss. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. Thank you so much for your time, gents. It has been a good day. US, Europe, and also here in South Africa, looking at the JSE. Andrew, just talk to us about what buoyed the markets today.
I think seeing the results from TSMC earlier today probably helped a bit. We were discussing, internally this morning about ASML's results yesterday and how the guidance was really weak. And I think there was a little bit of a kind of a shock through to the semiconductors around the world. But then thankfully, TSMC's results this morning were a lot more positive, really strong guidance. So I think that created a bit of a better mood globally with this whole AI theme that's kind of, it's a massive theme with what's going on around the world.
Indeed. Gary, what has stood out for you in today's trading?
Well, I don't think anything stood out particularly. I think we're going through quite a volatile period just with, look, the US earnings season now kicking off properly. And I think that, I just get the sense that the market's treading water a little bit at the moment, waiting, I think, for the big tech earnings that are coming. We're going to get a lot of reports out over the next 2 weeks. So I don't know. It feels like the calm before the storm to me. I mean, you can see how sensitive. Andrew was talking about TSMC versus ASML, and you can see how sensitive markets are to sort of any news around semiconductors and chips. So yeah, I get the sense that we're almost in a holding pattern at the moment. Obviously, we saw obviously Mondi taking a bit of a bath earlier today on the back of its results. And we've got, really, I suppose the standout, if you have to look at it from a sector point of view, it's actually been gold. So we've got gold near record highs. We've got the currency blowing out all the way to around 1770. It was above 1770 to the US dollar. So that actually lit a fire under anything that looked like a gold miner today. So if I look at my trading screen, you've got Harmony Gold finishing up 8.68%. We've got Goldfields up 6.45%, and Anglo Gold up 5.24%. So obviously the operating leverage kicking in, the price of their product going up, and their operating costs not changing at all. So shareholders can expect a lot more. But yeah, obviously trading stocks and fun, they move around a lot, but they really were, I suppose, the standout for today.
Gary, just sticking with you as you're talking about gold, because DRD did have an update today, and I actually wasn't sure if the share price was boosted by the numbers or by the general gold sentiment, because there was always the risk that as much as the gold price might be up, but operationally a gold counter might not actually live up to the high prices that we're seeing. Did those numbers look good?
Yeah, I think they didn't. It's difficult to tell whether it was the tide rising or if DRD's boat was especially buoyant.
Yeah.
But it finished up just under 7% today. So pretty much in line with the rest of the gold mining counters. The results at face value look pretty good. The financial position is strengthening. So there doesn't seem to be anything materially wrong. I mean, gold production was up around 7%. Part of that was just increase 30% increase in milled ore. So overall it looked pretty decent set of numbers, and I think largely in line with what markets were expecting. Otherwise we would have seen some sort of divergence from the rest of the gold mining counters.
And the costs were down as well. Andrew, just coming to you, earlier on you mentioned ASML and TSMC. There's a question here. Both reported recently, and as far as I can discern, there is similarity in the reports. Why did the market react so differently? Were there similarities? Because I do understand you said obviously with ASML it missed guidance, but then with TSMC it seems that it went in the opposite direction.
Yeah, I think it's very much a guidance story. TSMC's guidance was extremely strong going forward, whereas ASML's was nowhere near what was expected. I think the market's got a bit of a fright. We did as well. We very much like ASML as a business. Great long-term kind of theme. They sit on the top of the supply chain in the semiconductors. TSMC is their client. And then TSMC sells the chips onto the likes of NVIDIA, etc. So ASML sits right at the top there. So they're both amazing businesses, but it came down to, guidance going forward.
Well, it's quite interesting. I think I actually did, was it Craig Pfeiffer that I spoke to on the day that the results came out? And I think the results came out 30 minutes before he came online, and he did have ASML as his stock pick, but even after the dip, he did choose it as a buy. So still the same, because the viewer does ask, but also, are they both a buy?
I follow ASML a lot closer, and we hold ASML for clients.
Yeah.
Still very much like ASML, but I think the next 6 to 12 months, I don't think we're going to see a U kind of shape or a V-shaped recovery. It might be a couple of months of kind of just chugging along before things come right. But long term, very much still like the business.
All right. On your side, Gary, because are they both still a buy? That is the question, both of them.
Well, I mean, you've got to be quite, especially, do you need to be choosy within the AI space at the moment? And I think for you got to remember, financial markets reprice incredibly quickly as well. So, we saw a 16% share price dump on the first day, another 6% down. A lot of that poor outlook is now already reflected in the share price. So, it's always difficult to tell in the short term, like how fast is a company going to recover? When will a market, see value in it again? Obviously the earnings are now through on ASML, but if you're a long-term holder, I mean, there's a kind of a monopoly in those lithograph machines. I suppose one of the concerns is the European regulation as well. I mean, obviously being a European company, so that maybe is one of the concerns about ASML. But yeah, we also hold ASML portfolios. We're currently adding ASML as well. TSMC is also something that we like. So yeah, I don't think you really need to be too choosy if you're just trying to, I suppose, capture the whole value chain in semiconductor manufacturing. So. Yeah, I think further down, if you're looking for the juggernaut in the industry, why not go directly to NVIDIA? That seems to be where all the value is being extracted at this stage. So, but yeah, I don't think anything materially wrong with either of them.
Maybe go big or go home. Maybe not go home. Let's get to the next question. The next question is actually an interesting one. It's on Anglo American. Could the panel comment whether the jump in the share price today can be attributed to better commodity prices or to the possible takeover talks with the BHP bulletin a day or so ago? Yes, actually, and it was quite interesting because I saw that BHP came out with a trading update, but its share price actually went down while all the resources were up, and Anglo American's share price was up, I think, almost 4%, Andrew. What did you make of these moves?
So for Bulletin, the update today looked pretty solid. I think there was a 4% production in copper, probably lighter than what the markets expected. That was probably the only little question mark on that update. But apart from that, it looked fine. So the only thing I can think of, why Bulletin was down today and Anglo's was up 3% was based on that news that, the Bulletin guys are in South Africa meeting with government, looking for a way to figure out how they can make this Anglo's deal work. They've got a time limit. I can't remember how long that time is before the deal expires. So. Yeah. Let's see what happens, but I think that's why Anglo's was up today and Bulletin was down.
Gary, do you think that this would be the time to maybe go in on a trade of a possible takeover? I do understand that, of course, that happened. When was it? Earlier on this year. But do you think for anybody that maybe wants to catch some upside on Anglo American, maybe this could be an opportunity?
Yeah, I definitely think so. I mean, resources are incredibly cyclical. So I mean, stock prices on something like Anglo are going to move around a lot. So a nice stock for traders as well. And obviously, it has come off fairly significantly. As Andrew was saying, check the wire feeds at the moment. Nothing standing out in red, but definitely that FT article around the BHP executive being in South Africa, is mentioned. So there's no other kind of fundamental reason that I suppose we'd see Anglo up, other than the idea that there is going to be further take up. Yeah, I think the rule is it's called the put up or shut up rule. you know, when making an offer, and of course they've now had to shut up for a period. But yeah, you know, looking at it, you know, Anglo American obviously, you know, is still unbundling, you know, a whole lot of assets, and they're almost doing what BHP has recommended. So you almost it sort of feels like the SAB AB InBev merger, you know, ages ago. It was, you know, you start getting the businesses in the shape so that the two puzzle pieces actually fit together and that the deal can go through. And it feels like, you know, while Anglo Executive has been quite negative on it, you know, it's starting to look more and more, you know, a shape that the deal could happen. So I probably, and I don't think Anglo American at this stage in the cycle is a bad bet for shareholders, whether there's a deal or not. So yeah, I think there's, you know, yes, we're in kind of the top end of the rate cycle, but interest rates are moving down. Yes, I think, you know, in the next sort of 6 to 12 months, we're going to see some economic pain across the globe, and I think it's going to make headlines. I don't know if we're going to go into a shallow recession in the US or what's going to happen, but we would expect economic data to get a little bit worse, you know, as inflation slows. But with interest rates starting to come down, you know, hopefully market participants can see through the cycle, and you know, you don't get the sense that these commodity mining, diversified commodity miners are particularly expensive at the moment, and a little bit of an improvement in the growth outlook globally, and their share prices should do well, you know, on the back of higher commodity prices.
Andrew, in terms of playing both BHP and Anglo, or one of them, I'm just wondering, do you go into Anglo American, which looks very cheap right now? Gary says that it looks good whether it goes into BHP or not. Or do you go into BHP that could potentially absorb this asset, this good asset? Or is it a matter of, you know, timing, you know, if you want to invest for the long term or the short term, where maybe you'd get more value out of Anglo American in the short term, maybe more value out of BHP in the longer term?
Sure. So our view at Sasfin is we like Booysen. That's kind of our first pick when it comes to the mining space. They are the diversified, low-cost producer. So that's kind of our resources holding with the biggest weighting. Then it comes to Anglos. We would probably look to exit Anglos if we could get 600 and above. Glencore is probably our second pick in the mining space. So it would be one Booysen, two Glencore. And if Anglos runs hard, we'd probably look to exit.
All right. Any idea why there was such a downward trend today for Pick n Pay? Well, it seems that the stock closed about almost 2% lower, but there will definitely be more action tomorrow, especially with the interest rates going down further, which provides more disposable income to households. Firstly, Gary, did you check out that trading statement?
Yeah, I'm checking it out at the moment, so I'm kind of just running through it. Yeah, it's not particularly detailed. I mean, it's obviously giving the ranges. It looks pretty shocking. You know, and generally, I suppose the trading statements after hours usually are. That's why they sneak them out after market, allow everyone the evening to digest and come in with sober minds tomorrow when deciding where they would like to open the share price. But overall, yeah, I think, you know, Pick n Pay's in the middle of a turnaround strategy at the moment. Obviously, new management in place. Obviously, they're talking up the Boxer results in this trading statement as well. You know, sales up 12%, obviously because Boxer will be unbundling, and I'm sure they're looking for a good listing as well. But yeah, looking at it, you know, kind of on comparable metrics, headline earnings per share expected to be down between 20 and 30%. So this is a mandatory trading statement. It had to be released to market because it's over 20%. So yeah, it doesn't look great, but at the same time, you know, I think Pick n Pay is currently priced to not look great. You know, if you compare Pick n Pay to you know, the likes of a ShopRite or a Woolies, you know, the share price has been marked down significantly, and they are, as I said, in the process of a turnaround. So if you're one of those investors that like a turnaround story and are looking to go bargain hunting, hey, maybe it's something to put into the portfolio. You know, year to date, it is up, you know, 36%. So. You know, I don't know if these results are necessarily going to spook the what are the crypto guys call it? The guys with diamond hands that have been holding onto their Pick n Pay shares. So we'll see how it opens tomorrow morning. Yeah, it looks bad, but then I don't have the expectations in front of me at the moment. So let's see how it trades tomorrow.
Well, it seems that the viewer basically is wondering why there has been a downtrend on Pick n Pay when the interest rates are going down. And of course, something that will provide more disposable income to households. I would imagine that obviously the high tide will lift all boats with the interest rate cycle coming down, and also the lower inflation. But will it lift all boats to equal levels, Andrew?
Yeah, I think that's a fair question. I think there's a few things going on in South Africa at the moment. We've got the GNU, the rand strengthened, inflation's coming down, interest rates are coming down. We've got the two-pot system, so some people have been able to, access retirement funds earlier. So that's all, positive. Oh, and obviously electricity. We can keep the lights on. Don't want to jinx it, but we've managed to keep it on for a while now. And so these things are all positive for consumer-facing stocks. Whether I'm going for the likes of a Pick n Pay, we are not. I think the likes of a ShopRite is probably the place I'd be wanting to kind of focus on companies that are just getting stronger. But then you've got to look at valuation, like Gary was saying, and ShopRite's valuation is a lot higher than some of the others. So, I'd be looking at ShopRite's, and on any weakness, that's probably one I'd be considering.
Well, the second question on Pick n Pay, Gary, and obviously after, seeing these numbers, is it time to sell Pick n Pay? And I guess the investor is, trying to figure out what to do in the morning tomorrow.
Is it time to, I suppose we'll have to see where the share price is tomorrow morning to decide whether or not to sell, because of course it matters. If the share price is down 10%, probably maybe not the best time to start selling. I think I actually put a what is it? I had to pick a short for you guys a long time ago. I think I said short Pick n Pay at 62 Rand. I mean, we think Pick n Pay is a weak company. It has been for a long time, and it comes down to your individual philosophy. As I said, if you're a value manager, or if you're a value investor, looking at a turnaround story like this, they've recapitalized. If you believe in obviously what management can do, and if management can turn the business around, then you probably should be buying Pick n Pay. Hang on to it. Give them room to complete the turnaround strategy. For us, I think I'm in the same boat as Andrew here. We hold ShopRite. We have for a long time. Our philosophy is kind of rather have a great company at a fair price than a fair company at a great price. Not that I think Pick n Pay is at a particularly great price at the moment. As I said, you've seen a big share price recovery. We're up 36% for the year. You might have this downtrend, but the downtrend is because the fundamentals of the business are in a mess. Sure, we kind of made lows on Pick n Pay, below 15. And we're back up to 26. So, if you had been, picking the bottom, you could have had a nice trading win. But longer term, to have this in your portfolio on a 5-year view, this really doesn't look good. And you really have to believe in the turnaround strategy. And I think, unfortunately, I've just been hearing about the turnaround strategy at Pick n Pay for the last 30 years, or 20 years at least. So a little bit, for me, I'm still staying away. And if I was holding Pick n Pay for now, I might not sell if there's a kind of a rush to the exit tomorrow morning. But again, we don't have it in portfolios. If a client came to us with Pick n Pay at this stage, we would probably be looking to exit and deploy it into something else that can do a little bit better, and will be more able to capture consumer spend in the next, say, 12 to 18 months.
Well, do you think Spar is one of those? Because there's a question. I think Spar is not out of the deep water with their Switzerland operation. Andrew, I'm coming to you. Please give your view on Spar.
So I wouldn't put Spar in the same kind of bracket as Pick n Pay, but they still had their own challenges. With the SAP rollout, that was a complete mess, and that they're trying to fix. So, like Gary was saying, ShopRite, and that's what I was saying before, and that's where I would stay. I would just stick with the dominant player that looks like they're going to continue taking market share.
I don't know. So, for, the dark spot, the really dark spot on Spar was Poland. So obviously the SAP implementation, and then the Poland operations, which they are exiting. But now Switzerland seeming also to be quite dark there. The viewer does say, I sold my holdings in Spar. There are better opportunities out there, I guess, agreeing with you guys. So definitely not a mistake to get out, Gary?
Also, Spar not not one that we've held and haven't held in portfolios for a long time. I think it's sure there was the what was the headline, the Poland misadventure, and I remember whenever you look at the results, it was fascinating to watch Spar's results over COVID because. They actually, that Swiss business actually did really well because they shut all the borders, and obviously Switzerland being, it's crazy I suppose the margins that are made just because of regulation within Switzerland. So because all the Swiss were essentially locked within the country, Spar's that Switzerland business shot the lights out because they couldn't drive across the border to Germany to do their grocery shopping. Looking at Spar, I think our challenge with Spar is that it's actually the business model. So as Andrew was saying, it's a very different business from a Pick and Pay or a ShopRite or a Woolies because it's essentially it's a buyer's guild. It's a franchise model, and through that, without the kind of direct corporate control that you have at the other stores, the implementation of technology is difficult. And I'm not talking about SAP necessarily, but you look at what ShopRite has done with Checker 6060. You look at what Pick and Pay is even doing with ASAP or Woolies is doing with Dash. Spar has their own version of that, but I couldn't even tell you what it was called because I haven't used it. I don't know. I mean, maybe there's viewers here that are going to come on and be like, "No, Gary, what are you talking about? We use Spar's delivery service all the time." But it makes it more difficult to roll out, these kind of last mile delivery programs. I think Spar at the moment it's a very different company. And it's a much more difficult business model to extract value from, and I'd rather be a shareholder of one of the kind of more corporately controlled stores like ShopRite or Woolies in the grocery space. And if you're looking to capture upside from the falling interest rates, I still think this was something that you probably should have been looking at kind of 12 months ago. But we were actively buying Mr. Price. I mean, Mr. Price we thought was an excellent holding, although we also took a lot of flack for buying that, but it seems to have worked out for us.
All right. Well, talking about preferences, let's get to your stock picks. Andrew, what are you choosing today?
Sure. So my stock pick tonight is United Health. So they kind of like what Discovery is in South Africa, United Health is to the States. They are the dominant player in 50 of the 52 states. Their share price fell earlier this week after their results. They dropped guidance slightly, not too bad, but it seemed like they got short-term headwinds. They're not structural long-term issues. They're short-term things that they can fix. The company's aiming for earnings growth of 13 to 16% per annum over the long term, and they're on a forward multiple of 19. So I think that's pretty attractive, and they're a quality compounder, great management team, great long-term track record.
All right, Gary, what are you finding attractive this evening?
Okay, so I'm going to call the top of the market. We'll have the Mag 7 down 50% in probably the next 6 months because my stock pick today is going to be NVIDIA. Obviously,
the juggernaut.
The juggernaut, and I'm putting it out because obviously we run a thematic AI portfolio. It naturally has become the largest holding just because of the growth. The methodology behind that portfolio specifically is to run the winners, and we looked at it. It also sits in our global equity portfolio. So we have a significant exposure to NVIDIA at the moment. And clients always ask, would you deploy for new clients? And yes, we do, and we would. So why would I still be buying NVIDIA at these levels at call it $140 a share? And this is in the face of a CEO that has come out and say they're not shy of setting expectations for their earnings either. I think he said Jensen Huang said the demand for the Blackwell chips is, and in quotes, insane. And it's difficult. Everyone you talk to tells me that this is hype and that NVIDIA can't go on like this. But the fact is, if you actually look at it and you look at their compound annual revenue growth, over the last 3 years, it's 40% sales growth. That's their compound annual growth rate. Over 5 years, it's 54%. We're expecting them to essentially double revenue again, in the next quarter. So It's massive. These kind of lofty. I mean, there's arguments about whether you can look at the PEs on something like Nvidia, but at 34 times sales. This actually isn't expensive if that growth is achieved. And all of this does come down to obviously your view on whether AI is going to be able to scale and whether compute is going to scale efficiently. But there is no indication at this stage that it won't. And the fact is that everyone that kind of tells me that this is a bubble, there's just so much skepticism out there. And that for me doesn't feel like a bubble. That feels like more of an opportunity. So we'll be definitely looking very closely on the 19th of November when Nvidia reports results. But I would say Nvidia is still a buy, and it should be in your portfolios because there's something very interesting happening in the world, and this is how you participate in it.
All right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guests, Andrew Padoa from Sasfin Wealth and Gary Booysen from Rand Swiss. Up next, I'm back with a close. Stay tuned.